Whoa, this is Michael Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up and ready for you to watch. Now, if you're not on my email list, go below the description of this video and you'll see a link to join, because every single trading day I send out an email before the opening bell with the top market headlines I think you need to know about, plus my own commentary in the markets. And we're in a critical, fascinating time. I will talk about the stock market this week in a few minutes, but in this video, what I want to draw your attention to is the single most important trend impacting the financial markets. It doesn't matter if you own a fund, an exchange traded fund, an individual stock, whatever it is. I think what you own and what you buy going forward must benefit from this trend I'm going to talk about in this video. Everything is revolving around this one trend. And we're in a moment in which a lot of geopolitical news has happened of grave significance. Russia invaded Ukraine. We've seen a lot of volatility in the financial markets. The NASDAQ had its worst January month ever, and then bounced in February. That bounce faded, and people are trying to predict what that's going to do. But I want to suggest to you that predictions, no matter who makes them, are completely useless, because nobody can really predict the future. And the thing is, you don't need to predict the future to figure out what the best way is to profit and benefit by the way you position yourself in the financial markets. No, what you need to do is simply identify the major trends that are happening and align your investments to benefit with them, and pay attention in case new trends come to displace the big trend happening, or that trend fizzles out. Things change. And we are now in a moment of huge changes that I cannot tell you how they're all going to play out. The Russia invasion of Ukraine is going to have bigger geopolitical implications for the United States, the entire world, the entire financial system, bigger than the 9/11 attacks, the war in Iraq. This is an event that is going to be as big as the fall or the Berlin Wall in the way it changes the international order, and perhaps even the international monetary system itself, which has gone through two phases since the end of World War II. The first phase was the establishment of the Bretton Woods system, and it lasted until 1971, when Nixon took the US dollar off the gold standard, ended the Bretton Woods system, and free floated all currencies on the global markets. And he did a deal, and so did the Ford administration, to link the dollar to the petrodollar, to the price of oil, to get the Saudi Arabians and OPEC to agree to use the dollar as their main way to transact oil. And anyway, I'm now getting into many complicated topics, but the important thing to understand is that the US dollar became the reserve currency of the world, not after World War II, to maintain that status with this OPEC deal made in the 70s. But the war that began the other week and the reaction to Russia, the United States deployed the US dollar not simply as the reserve currency of the world on Russia, but as a weapon of war, economic war, a different form of war than you have ever experienced before. And it is happening. But what does it mean when the reserve currency, the dollar, is no longer can be used as the reserve currency, by the Russian central bank? Well, that question is now going to be a giant, has many ramifications. Try to answer it. Many people around the world are trying to answer it. I don't know how they're going to answer it, but this is a big event. It's unpredictable how it's going to play out. Something we'll talk about in the future. That, you know, I don't think people are thinking about this. I don't know if other people are even talking about it with you. You know, so much of the financial commentary is simply hype about Tesla and Bitcoin and not these larger issues. It's so huge. But let's put that aside. We're going to get back to what, you know, the one underlying trend, one thing to focus on, because if you want to make money, all you got to do, you can't figure out it. You don't need to figure everything out. Just figure one big thing out. And the big thing I want you to see is what is the biggest trend impacting all markets, all stocks. And the trick is to align yourself with it. And most people are not doing that at all. Most people are simply buying the Teslas, the Rivians, Amazon, Netflix, these stocks, you know, they're still remain the top 100 Robinhood stocks, and none of them are aligned with this trend. So they're not things I would be putting money into. So to get to it, let's step back and think about what just happened last week. The CPI data came out with a record 7.9% print. Now, this article is from CNBC the morning before, or a day before that, but I just want you to see the chart here. So what you see is the chart of the consumer price index. You can see how since, let's say, 1990, it stayed below 5%. Really, it stayed below 2% almost every single year, with one rare spike in 2008 when energy prices spiked up temporarily in a way they have just done once again, which probably isn't temporary as it was in 2008. But regardless, the point is we are broken above, you know, that high, the high of 1990, really at 7.9%. And you've got to go back to the 1970s, really, to see a breakout like this, where inflation was, well, really 1967. Inflation was low from really 1948 to 1967, then broke out, just as it did now. It didn't break out to 7.9%, but it did break out, and it came back down. Then you had a big breakout in 1973. I believe the inflation we're seeing now can be best understood as something similar to what happened in 1973. Now, keep this in mind. Interest rates are zero. Interest rates are zero. Yes, the Federal Reserve is expected to raise rates in the next couple of days by 1/4 point, but still 1/4 point is much lower than 7.9%. Rates are way below what inflation is. That fact is the biggest underlying trend in the financial markets, in the economy. The fact that rates are zero and inflation is 7.9%. There are ways you can invest that benefits from that. One such way is real estate. You know, you can go take a mortgage out, let's say at 4.5%, and you can expect the real estate prices to go up over the next couple of years at a much higher rate than the money you're borrowing. You are basically borrowing, if you buy real estate, at a negative yield. So that's a way you can actually benefit. But there, many people obviously are not benefiting when inflation is 7.9% and they don't have access to the bank lending. They're not doing it. I'm not doing it, but I'm doing things in the stock market to benefit. That's what that's what I'm going to talk about. But, you know, if you're just living on fixed income, you are really getting hurt You know, if that's what's happening, you're renting, let's say, and you just have this fixed income, you're really getting hurt when food prices can go up, and rent goes up, when the price of gas goes up, and so forth. But this is the biggest underlying trend in the economy and the financial markets. Now, to understand how this is impacting the markets, I'm going to talk about two ways it is. The first, let's look at the 1970s. So what you see in this chart that goes back to the early to like 65, the red line in this chart is the consumer price inflation rate. As I said, I think this is like 1973 where you broke out. You can see the little spike above 5% in 1970, but it broke above that in 1973 and got to over 10% in 1974. And then it dipped back down and it went back up to close to over 12.5% by 1979. Now, and then as you can see, that was the peak, and it fell really in a secular decline up until last year. Last year, really, that's when it started to break out, but it broke out to new record, you know, went above last year's high this month. Okay, that's what inflation has done. But the blue line on this chart is what is really important for you to think about. That blue line is the Federal Reserve funds rate. That's the interest rate that the Fed is set. It's at zero now, but the Fed is set to take it to raise it a quarter point next week. Here's what I want you to think about, though. You can see in the 70s how, you know, in 1970, the Fed funds rate was higher than the inflation rate. And when inflation went down, the Fed funds went down, and when inflation went up, it rode it up. And so the Fed was keeping rates from the beginning of this chart to about 1975 at above the inflation rate. And if inflation went up, they would raise the rate. In 1974, there was a sharp recession, and the Fed ended up lowering rates below the inflation rate as a result of that recession. But one effect that had was to exasperate the inflation situation. So inflation shot up, you know, to over 17%. I'm sorry, over 12.5% in 1979. What this suggests is several things. One, that raising rates helps to slow down inflation and reverse it. But if you keep rates below the rate of inflation, the Fed is helping to increase inflation. It's not fighting it. When rates are zero, as they are now, and the inflation rate is 7.9%, the Fed has a long ways to go to raise interest rates above the rate of inflation. It's unfortunately unlikely to even get there this year. That means the situation we're in now of high inflation is not going to go away. In fact, Janet Yellen even admitted that last week. She said inflation like this is going to continue the rest of the year. Well, that's one implication. Another implication is that it's going to take a long time for the Federal Reserve to really bust inflation like Paul Volcker did in 1979 and 1980. It's going to take a long time for the Fed funds rate to get above the rate of inflation. Well, that is the number one trend, the strongest trend in the markets. I've just explained it to you. That's it. It's not a volatile trend, doesn't change day by day. It doesn't make the stock market go up or down 5% or 3% or 10%. It doesn't affect the daily action of the markets, but it affects the fundamentals of every single company operating in America, which does impact the long-term trend of stocks. There are companies that are going to suffer from inflation and the eventual rise in interest rates. Most technology stocks will suffer from this. Companies such as Tesla will suffer from inflation going up. They're not as easily able to pass on the increased production costs to their consumers. However, there are companies that benefit or can pass on the costs very easily. Real estate companies are one example. If you own a house that you rent out to people or an apartment, you can raise the rent every single year. So when inflation goes up, you can raise the rent, and do fine. And you got the fixed cost if you took out a fixed rate mortgage to finance this house or property. So you actually are positioned, if you were to take out a loan for $100,000, rent out an apartment at a fixed interest now at 4.5%, and you increase the rent by 10% next year, and let's say 5% every year after that, because we have inflation that goes on, your costs for the value of your money, or really your costs are shrinking as you are able to increase revenue. That's why real estate was a great investment in the 1970s, is a great investment today. I'm not running around investing in physical real estate myself, but I own REITs. And you can track what they're doing through the RWR ETF. That's an ETF that just specializes in REITs. What I would not do is think that if I go and double down on Apple or Netflix or anything else of these popular high technology stocks or ARK stocks owned by Cathie Wood, that that's just what you need to think about. Is the stocks I own, the sectors I invest in, positioned to benefit from real estate or benefit from inflation or suffer from it in rising interest rates? And interest rates have a long ways to go up, obviously. And because the bonds when their yields go up, the value of the funds go down. That means bonds are in a bear market that's going to last for years. Bonds are no longer safe havens in an account. Bond funds are going to lose money. Bond ETFs are going to go down. So one of the strongest trends in the market is the decline in bond funds such as LQD and J&K for junk bonds. These are falling in many ways in a sharper downtrends than the stock market. They're in vicious bear markets. Now, yeah, you can get bounces in bear markets, as you see. This bounced in February and it just continued lower. The underlying trend is so bearish for bonds. If there's one trend above all that's the strongest, it's that. But falling bonds and rising yields causes the cost of financing for corporations to go up. So companies that are heavily in debt and issue bonds on a regular basis are among the worst to buy and invest in now, because they're going to suffer the most. Netflix is one such company with mega billions in debt, and it has to issue junk bonds every year. Casinos are in the same position. Here's MGM. That one doesn't look so bad. The Las Vegas Sands does. I would not be a buyer of casino stocks or an investor in casino stocks. Energy stocks, though, obviously are benefiting from inflation going up. Gold and silver are benefiting from inflation going up because people need safe havens to invest in when bonds are going down, and big money will shift money out of fixed income and bonds during times of inflation into safe haven assets. So it's just the questions I want you to focus on. The biggest trend, inflation. Inflation means rising rates over time. That's the biggest axis around all long-term underlying trends of these markets. I think the thing to do is invest in stocks, sectors that will benefit from this. And that's a sea shift change from what happened after March 2020, when rates were taken to zero and there was no huge inflation, no imminent interest rates. We're in a different world now, and it's time for people to start The quicker people adjust to that and think about it and position for that, the quicker they can benefit from that. Simple as that. Simple as that. Now, that takes stepping back from things, thinking about things, a lot more work than most people in the market are willing to do. Surely more work than someone that's only interaction with the market is having the Robinhood app on their phone and staring at quotes and the top 100 list. That's not going to get you anywhere in this market, because it's not doing work. That's just chasing what other people are doing, what the herd's doing. You could take this, may require someone that's new to these, doesn't really understand how bonds and inflation work, to spend an entire week reading about it. It may require that. But if you want to really make money in the markets in a serious way, you got to take it seriously. The quick money of playing apps, it's over with. That was just for a few months. As far as the stock market goes, this is an ETF for Germany. It's in a bear market. It's trading below the 200 and 150-day moving averages. Most world markets are now doing that too. The European markets are among the worst. Obviously, you can figure out why. It's not too hard. But what does this chart action suggest is going to happen now? So this thing fell so sharply once that Ukraine war started. I mean, from 32 to 24 is a sharp percentage decline for a stock market. So it bounced from 24 to about 28, 24 and a half to 28. Well, that type of sharp decline and bounce suggests to me that there's not any real meaningful upside here in the short term. The fact that all this doesn't tell me anything about what's going to happen 6 months from now. I'm just talking next week. They're really, the idea that this is going to rally straight back up to 30 or something, that's not going to happen. If the bullish scenario would be that this ETF, that the volatility shrinks, it pauses here, it trades say around 27 for several months probably, and then turns up, and then you resume, you get back up to those moving averages. The bearish scenario, of course, is this is a dead cat bounce. I'm not trying to tell you which it is. I'm just trying to suggest that short term, there's no real sustainable upside here. And that's the story for all broad market indices right now, because everything's kind of trading together. This is just trading worse than the US stock market. But if you look at the NASDAQ, here's the triple Qs. It's had the same basic price pattern. It's been sliding since January. But it's broke. The pressures of the global market suggest to me that this thing is not going to get above 350 over the next couple of weeks. It would take some stabilization here and some work. And what if we break to new lows? The VIX is hanging around 30. I sent out an alert, I think it was last weekend, saying if the VIX got to 40, I would think we'd get a bigger rally than we have. But it didn't happen. So people are fairly complacent that are inside the stock market. So all I'm trying to tell you is this is not a week I'm excited to rush out and do a lot of buying. Instead, I think the thing to do is if you've been trying to trade these markets and if you're not up this year, and you've been trying to do lots of trades, it's time to stop and just take time to study, take time to think about inflation and the impact that has on various companies and the stocks that represent them. That is the trick and secret to being one of the winners of this market now going forward. And that's the message I have for you today. Now, if you like this, please hit the like button. This type of message is not popular on YouTube. 99% of traders and investors, they just want hype. A lot of people on YouTube simply repeat the themes and words of Cathie Wood because that's what people want to hear. People own Apple, they own the Netflix, they own Facebook and these stocks, and they want to be told technobabble, to be told it's going to do great. No, it's not, because these stocks are not poised to benefit from inflation. Something like Netflix is going to get killed by inflation and the cost of debt, that it increased costs and debts. That's the way it is. So please hit like so YouTube will know, hey, some people do like this. If not, then what happens is YouTube just says, oh, this isn't popular. It's not one of the Cathie Wood type videos. It's just no one wants to see it. If you do want to see the next video, what you need to do is hit the subscribe button and then hit the bell, and then YouTube will send you a notification as soon as the next video is up for you to watch. So let's see what happens this week. It's going to be interesting to see the commentary surrounding the Fed on Wednesday. And, what does the NASDAQ do here? Can it hold the February low, or, and be a little bit more constructive from a bullish standpoint? And we'll see what happens. So happy trading. Have a good week.